Hello, everyone. Today on the final bar, we're broadcasting live from New York City, doing some interviews this morning. We're going to share with you one of those conversations with Jonathan Krinsky, who's the chief technical strategist at Bay Crest Partners here in the New York area. Going to hear from one of my friends, Greg Schnell, about Keltner channels. Interesting technique if you've not seen it before. And in a shifting stock segment, what is moving and why do you need to know it? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com, normally from Redmond, Washington, but today we are, in this week, we are on location in New York. Really have enjoyed with the show, getting out of the Seattle area, visiting some noted experts around the country. And this week we decided to come to New York. Some really cool conversations. We had a number of them this morning, guys like Jonathan Krinsky from Bay Crest Partners, who we're going to hear from in a little bit. We sat down with Tony Dwyer from Canaccord Genuity, Sam Stovall from CFRA Research, Steve Suttmeyer from BofA Securities, some really accomplished technical analysts and strategists. So we're really excited to share some of the things they discussed today about a market outlook, also about their process and how they think about things, adversity they faced, and all sorts of stuff. So some really cool conversations. And again, we'll share with you one of those today. You know, one of the consistent themes when I was talking to everyone this week as we transition into the market recap portion of the show is just the overall market environment. We're at the seasonally strongest part of the year, November through April, and then May through October since to be the more weaker part. So we're at the seasonally strongest part of the year, but where are we left with the market sort of testing new highs, but a lot of stocks, sort of pulling back a little bit. We're going to talk about Apple and Disney in a moment. And some divergences that I'm seeing. Also, healthcare is an example of that. So let's try to piece together what we're seeing from today's trading, how that connects to the long-term trends, some of the themes as we go through a shifting stock segment later about it. Looking at the chart of the S&P 500, here's today, a little bit of a pullback today, following through from Friday's distribution Thursday of last week, a nice run. It looked like we were sort of off to the races, heading to new highs. But then the last 2 days, a bit of a settling down. Obviously there's a lot of potential news catalysts coming through, things like the Fed and et cetera. But in the end, price is king. Price is the most important thing we can follow. So understanding this trend in the price and where it's headed, I would argue is the most important thing we can do. And if you look at that, what we have done, if you look at just the last 3 days, we sort of gapped up near the previous highs, and on a closing basis, the second highest closing high that we've had so far this year. And then we've pulled back a little bit. And it might be too early to say whether or not this is a lower high, but boy, it's starting to appear that way. 3150 to 3155 being sort of the ultimate resistance level now in the S&P 500. And during the course of this week, if we continue to pull back a little bit, we've then, again, on this short-term sort of tactical time frame, looking at the last 6 months on the daily chart, that's a lower high. And again, uptrends are made of higher highs and higher lows, meaning if we look at each of these subsequent peaks in the price, they keep going higher. We've now potentially established a lower high. So, how do we decide whether or not that's the case? Well, I would say this week is pretty key. Do we pull back and then continue above 3150, sort of retest those highs, or does this continue lower? And if we get a little bit lower back into the 3110 sort of range, sort of where we were mid last week, I think that suggests a lower high, a little more distribution than accumulation, potentially more caution leading into year end. Looking at the short-term trading, so this is what today sort of played out. We have a little bit of distribution going into the close. We almost closed near the lows of the day, but pulled back a little bit sort of in the last half hour or so. But overall, nice rally out of the open. That's usually when the market reacts to overnight news, a lot of retail investors. But if you look at the rest of the day, is really more distributive. And what concerns me here is the last 3 days have had that similar kind of pattern. A rally out of the open. The first part of the day shows accumulation reacting to whatever happened outside of market hours, but then the majority of the day is more sellers than buyers, right? Shown by the lack of demand or increase in supply. So overall, certainly more short-term, tactically weaker here is what we've seen. Now, again, a consistent theme with all of my guests. I mean, it's hard to not still see the long-term uptrend. So again, always orient yourself. The first chart you're looking at as a long-term investor, in my opinion, should be something long-term. So this is the last 7 years of the S&P 500 on a weekly chart. Start with this. Orient yourself to this sort of trend. The trend overall is still very, very positive, and all that short-term tactical stuff I just talked about is this little blip on the far right side. It's the final bar, along this whole 7-year trend. So let's keep in mind we are still very, very close to all-time highs. I'm just starting to think tactically. What do we do into year end, and again starting to see some distribution end of last week into this week. Let's look at the market dashboard to see where things sort of played out. The S&P essentially flat, down 0.1%, so really not much of a movement there. And again, that's because of the sell-off. This is Friday, and then, or sorry, yesterday, Monday, and then this is today, sort of near the low. So sort of a similar type of pattern. Small caps up a little bit more, mid caps up around the same amount, but again, nothing really dramatically different. On a sector basis, worth noting, energy and healthcare and technology were the only three sectors to finish in the green, the positive. At the bottom, we have real estate, materials. I think it's interesting that the consumer sectors continue to move in lockstep, which is what's really, really interesting. I wanted to just look briefly at a couple of these charts that I think are really, really interesting. Talked about the sectors, and if we look at the sector charts, I want to point out the fact that healthcare, for example, is one of those that's showing a bit of a bearish divergence. And this, every weekend I do a pretty thorough look at all the S&P 500 charts, and I try to get a really good sense of just where things are at. And again, it's not, I wouldn't make many trading decisions based on that view, but I want to make sure I just look bottom up across all of these charts and just see what themes sort of bubble up. And I'm going to show you real quickly here 3 divergences that have jumped off the page of me this weekend when I was doing that review. Number one, this is the XLV. So we see the higher highs looking at the last 2 years. You see the higher high in price over the last 6 weeks, and you see the lower high in RSI. So that suggests a lessening of momentum. Higher highs are good, but lessening of momentum tends to happen at market tops. That tends to be an exhaustion of momentum, an exhaustion of buyers, lessening up a little bit. I'll go very quickly through 2 other charts. This is Disney, and we see the higher highs in prices a little further on because it's pulled back a little bit since this divergence, but you see the bearish divergence here of lower peaks in RSI while we have higher peaks in the price of Disney. And then we're looking at Apple. So again, this is not universal. It's not that every stock out there has this, but if you see, again, the fact that Apple, one of the biggest stocks, huge benchmark name for anyone, any institution betting against or trying to compete against the S&P 500, higher highs in price, lower peaks in RSI. And again, that tends to happen at market tops. It is not 100% correct. Not all market tops occur right then, but it is sort of a warning sign that I would certainly be paying attention to. So in terms of a market recap, a little bit of distribution. What concerns me at a high level are some of these bearish divergences. Again, price is king. So as long as price keeps going up, we're in pretty good shape. So I wouldn't be too worried about it going into year end here. With the next segment, we have a segment called Talking Technically, where we bring in some of my fellow StockCharts contributors here, how they use technical analysis, how they employ it in their process. We're going to hear from my friend Greg Schnell, the Canadian technician, talking about Keltner channels. So here's some thoughts from Greg Schnell on Keltner channels.
I want to talk about Keltner channels. Keltner channels put a band around the price, and they take into account the volatility of the stock. So they use the average true range, so the distance the stock moves every day, and it calculates envelopes, a high and a low around that, and you get to set how far those are apart based on the average true range. So I'll show you the first one, and then we're going to break into putting on increases or multiples of those envelope sizes so that you can see the effect of having different ones and why you might want to choose them. So first of all, I've set all of these to 0, so you just have the price up here. Next, I want to go down here and just change the opacity. In this case, I've set them up so that you could see them. So in this case, these blue ones are set up relatively tight with 1.0 as the control point. And you can see that a lot of the price action occurs outside the band. So what you want with a Keltner channel is you want to try and set it up so it's near your extremes. So in this case, we're going to go down and we're going to add this red color one, and it's set up, so the volatility on this one was set up with 1.0. This is 2.0 ATRs and 3.0 ATRs. So you can make it 2.2 or whatever you like. And here you see I've got a 2% or 2 times the ATR, and what you look at here is you can see that this is sitting pretty much controlling of the price with the exception of the August-September downtrend. So that's probably not a bad place if you entered and got in near the lows and then you want to sell up near the highs. So here you'd have got a sell signal. Over here, price didn't get there. The price label did, but price didn't. So it's a little too wide for the current trading. Anyway, lastly, you could add another one, and in this case, we're going to add 3.0 ATRs, and then you can see that this is really wide and price actually never gets up near there. It controlled this really big area down here, but for the most part it's set up so wide that the bands aren't useful. So the idea behind them is to try and find them near the lows of the bands and near the highs of the bands, and each stock, depending on the type of investment it is, will have a bigger range or a smaller range. So you might find drug stocks or defensive stocks have a lot less movement on their ATR, whereas the stocks like Amazon or Spotify or something that have bigger movements throughout the day have wider ATRs, and then you'll need to set your bands wider. So set it based on how big the stock moves back and forth, and that way the Keltner channels will help you a lot more finding low entries and high exits.
So that was Greg Schnell talking about Keltner channels. And again, if you're not familiar with an indicator like Keltner channels, it's a little bit down the list probably for a number of you, something that you may have seen before but hadn't used a lot, or maybe it's a totally new concept for you. I would tell you the technical toolkit is very diverse. There are a lot of different things in there. Keltner channels for me are in that basket of indicators, band indicators or volatility indicators, things like Keltner channels, moving average, envelopes like a percent envelope. Bollinger Bands were certainly an attempt to improve that model and adjust for volatility over time using standard deviations. That sort of thing you don't see me using a ton, and that's only because I studied things like Keltner channels along with Bollinger Bands and all these other things. I, went through them, and as I was designing my own toolkit over my career, eventually found other things that I wanted to prioritize over these. But I would remind you again, if you are earlier in your journey and you're just trying to learn the toolkit, it's great to experiment with some of those sort of things. And you might find with an indicator like Keltner channels just does a good job of showing with certain stocks where they're at relative to that normal expected range. So if you're not familiar with it, Greg did a great job describing it, but check out Chart School. Just search on StockCharts for Keltner channels to get some more descriptive information about how to use that particular indicator. We're going to take a quick commercial break. We'll be back with my interview with Jonathan Krinsky. So I'll see you back here in 1 minute.
The Chart Watchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the Chart Watchers newsletter.
Here at StockCharts.com. Thanks for joining us on the final bar. As I mentioned in the introduction, we're on location this week in New York City, having a really good trip so far. Having fun actually with StockCharts.com, meeting with some of our vendors, make sure we're building good relationships, keeping the service going well with some of our partners here in New York, but also using it as a really good opportunity for StockCharts TV to create some really good content, capture some insights from some really fantastic experts, and sat down with 4 different analysts, strategists this morning to sort of talk through their process and talk about the market outlook and what they're seeing, what they're thinking, and a lot about their experiences over their careers. some really good stories, some really good ideas came out of it. I want to share with you a snippet of our conversation this morning with Jonathan Krinsky. Particularly, we're talking about 2019 and sort of the challenges of a market rally, a strong cyclical bull market, but with some leadership challenges, defensive stocks leading over offensive stocks at times. And then a little bit about what he's seeing going through year end and into the beginning of 2020. So here we're going to share with you a snippet of our interview with Jonathan Krinsky. He's the chief technical strategist at Bay Crest Partners here in the New York area. So here is my conversation with Jonathan. So we're here with Jonathan Krinsky, Chief Market Technician at Bay Crest Partners. Thanks so much for joining us, Jonathan.
Yeah, it's
good to see you. You talked about some leadership, technology, and otherwise. How did you think through this year? I mean, it was a really interesting environment where a bull market phase, overall, U.S. equities doing fine, global equities holding up okay, but you had a lot of leadership from the defensive side, from utilities and real estate for a lot of the year. I ended up, looking like the top sectors. Fantastic charts. Same thing, like small cap underperforming at a time when you'd probably expect it to outperform. How do you, as an analyst, balance those messages of the chart going up of the markets, but then the leadership picture gets kind of cloudy or unintuitive? How do you balance those kind of things?
Yeah, I think obviously we talked about interest rates are driving a lot of the correlations and the trades. So the kind of message early in the year and into the summer as the macroeconomic data was kind of getting a little weaker, I think people were kind of using the bond proxies as a little bit of a hedge. I heard the barbell strategy where you'd buy high growth names that do well when overall growth is lower.
Right.
And then you also are buying some of the defensives, which give you a little bit of safety. If bonds continue to move higher as they did throughout the summer, they actually do well. So I think it was a little bit of masking some of the concerns the market had, in the sense that if we came into the year and told you what interest rates were going to do, and they were going to continue to move lower, and some of the concerns globally, you may not have thought the market would have done as well as it did, but it did because instead of going to cash, investors were actually buying the defensives and the safe havens, as well as the high growth names, which are actually such a big part of the market. I think a lot of people forget that software is actually, you can divide the market into 11 S&P 500 sectors, and then below that you can go into the industry groups. There's 24 of those. Software is the biggest industry group weighting in the S&P. It's about 12%. So when you have investors moving into the high growth, a lot of those tend to be software names, which have done well as interest rates have moved down. So the market's actually done pretty well, even though if we had told you what the macro data was going to do, what bonds were going to do, what even gold was going to do coming into this year, you may have not thought that would have been the case. So it's been an interesting year in that sense.
What do you think when you're looking into year end and just we're in the seasonally strongest part of the year now, November through May. We're in a position where the market's now at or near all-time highs. IFA in sort of developed Europe and Asia testing maybe even to new highs today. How do you think about that going into year end versus, potentially we're overextended, depending on some of the charts, you're getting divergences on a chart like Apple, you're getting, higher highs, but, momentum's starting to slope down. What do you see going into year end and into the beginning of next year?
So I think the biggest message from us is that global equities peaked in January of 2018. Most global equities, if we're talking a broad basket of global stocks, have still not surpassed their January 2018 peak. Small caps peaked, I believe, in September of 2018. But for all intents and purposes, they haven't gone anywhere either since January of 2018. So we've had this 18 to 24 month period of really just sideways congestion for global equities, for small cap US equities. So our view is that that's a pause. And by the way, throughout that period, we had the big drawdown in the fourth quarter of last year, which didn't quite get to 20% of the S&P 500, but for all intents and purposes, most stocks under the surface experience a bear market. So we're of the belief that we've gone through this sideways consolidation. We're now starting to emerge higher from it. Yes, some big mega cap stocks may be a bit extended, and that's kind of led to the S&P and the NASDAQ showing some bit of negative divergences. I think the bull case, though, is that we see a bit of a rotation Our call actually for the next few months is that we finally see that relative strength in the small caps. Seasonally, we actually tend to see a bottom in the relative performance of small caps to large caps around November, December.
Okay.
And then you see that relative strength actually, and again, this is just the average historical pattern over the last 30 years, you tend to see some outperformance in small caps into the springtime. So that would kind of make sense from a seasonal perspective. We also have an interesting dynamic. We looked at when the small Russell 2000 has gone at least 52 weeks without a 52-week high.
Okay.
And then you finally make a 52-week high, what happens going forward? And that's happened 11 times since the Russell 2000. We have data back to about 1979.
Yeah.
And 10 of 11 times when that happens, small caps are actually higher 6 months later for a median gain of about 13.4%. So basically, what does that tell you? We've gone a mini bear market, whether it's a 20% drawdown or not, we haven't made progress in 52 weeks. You finally emerge from that base. That tends to bode well for small caps going forward. So that's kind of how we're looking at things right now.
Very interesting. I like how that lines up potentially. So that was just a piece of my conversation with Jonathan Krinsky earlier today. And I tell you, I hope you get a sense of how rich a lot of these conversations were. It's such a cool opportunity to pick an analyst's brain, pick a strategist's brain, really understand what they're seeing, what they're thinking, but get a little level deeper. Here we talked a little about more of a market outlook, but we unpacked a lot about Jonathan and the other analysts, their processes, how they look at the markets, how they what routines they have, what formative events in their career help shape who they are. So we're really excited to keep bringing you more of those conversations going forward. But I thought Jonathan's take in particular about the yield play and the successive defensive this year, that was really, really well described. So more to come from Jonathan and many others going forward. But we're going to move forward today and go into a segment called Shifting Stocks. This is one of my favorite segments because it focuses on more of a bottom-up process. I talked with a number of the analysts today, Steve Seltmeyer in particular from BofA Securities, about the balance between the top-down, and that's what is the S&P doing, what are the broad markets doing, what is gold and interest rates, all of that, and combining that in a meaningful bottom-up process, meaning looking at individual stocks and trying to think through them. So I'm showing you a candle glance page that I have up. I use a lot of different tabs when I'm looking at StockCharts.com, but one of the ones that I look at all the time is a candle glance of the 30 down members. And I do it not because this is the universe I'm looking at or anything where I think it's a great benchmark. It's because it has a number of different types of stocks in the same place. And if you want to get a good, quick bottom-up read on what's happening in the equity space, look at a candle glance page of a group of 30, 50 stocks, something like this. So the Dow is very easy to import the members into a chart list, and then you can quickly do these. Now, I'll show you sort of how I'm doing it. I intentionally just sort them alphabetically because I'm not worried about the sectors. I just want to look across the board and just see what sort of patterns emerge. And this goes back years ago when I would routinely actually draw out by hand what patterns I had seen looking at the S&P 100. I'd go through the entire OEX 100 charts, and I'd jot down the tickers based on what patterns and group similar patterns together. And I'll do that exercise with you really quickly here as part of the Shifting Stocks segment so you can see what I mean. So the first bucket, as I'm looking at just sort of what patterns do you see? I would say the first general bucket looking at these one-year charts are stocks that are up and to the right. These are stocks that are long and strong in clear uptrends, doing very, very well. And if I had a portfolio that looked like this and I bought them a year ago, I'd probably be really, really happy because they've clearly done very, very well consistently. So Apple in the upper left corner makes sense, right? This is probably the first one that jumps out of the page. JP Morgan here jumps out as well in that similar kind of bucket of long and strong up and to the right. Microsoft, Nike, all appearing in that similar sort of pattern. So you get the idea. Stocks that are sort of bottom left to upper right, above two upward sloping moving averages, these are doing really, really well. The second bucket I would say are maybe stocks that have pulled back recently, more basing patterns, and either have broken out or are really close to breaking out. So these are stocks that are more, in long-term basis. Goldman Sachs maybe comes to mind there. A stock that's at a consistent resistance level, tested it, just looks like it's breaking out. And again, the point of having the small chart and looking at a bunch of these, just the 30,000 foot view, what type of patterns. Nike maybe is more of this type of pattern, which, has had a little bit of a rounding bottom breaking to new highs. Merck comes to mind, again, something that had been sideways consolidated for much of the year, but now breaking to new highs. So a number of stocks sort of fit into that bucket. Then we start to get into some more challenged buckets, if you will, things that don't look as attractive, things that have struggled a little bit. And what's interesting right now is I think you get a real good dispersion. While plenty of stocks look pretty good, you have something like American Express, which is not up and to the right. It's pulled back a little bit. The moving averages are flat. They're not sloping higher. We're above the two moving averages, but they're not, there's not a lot of daylight between them. So it's a little bit of a sideways move. Chevron comes to mind as something that's essentially flat. It's sort of this pretzel-like thing where the price and the moving averages are all on top of each other. So you have these things that are sort of stagnated. Boeing is another one that's sort of in that bucket. Then you get into things that are really distributive. And the things that jump out, DuPont, 3M, some industrials names. What else comes to mind? Walgreens, right? Walgreens Boots Alliance, which had rallied but now starting to suffer. ExxonMobil below the moving averages. So when I think of stocks shifting, when I think of a shifting stocks sort of approach, I'm looking at this candle glance page of the Dow and I'm mentally starting to bucket which ones are in there. What I would encourage you to do, if you've not done this sort of thing before, take that process that I just did, but put your holdings on this candle glance page. Look at your portfolio or even the ETFs you're holding, even the top 10 stocks if you have a lot of names in there, and look at them in this way and start to bucket which ones look similar and start to think about sector themes, market cap themes, the types of names, growth versus value, and you will start to surface some themes, some ideas that might be really interesting to dig into. That's all the time we have for shifting stocks. So we're going to move on to the 3 and 3. At the end of every show, I like to show 3 charts in 3 minutes. If you've not looked at these yet, put them on your radar. Do yourself a favor and make sure you follow these going forward. There is a theme to these 3, and I will show you. Number 1 is the XLA, the energy sector. The reason why I'm showing this one is I've heard a number of people talk about energy potentially, being an interesting play here. It's sort of a late cycle leadership type of play, a pattern of higher lows, a little bit of a lower low recently at the beginning of the month, but overall holding up pretty nicely. Again, it does not look anywhere near as good as many of the other charts that we've seen. Just looking at the Dow, this would probably be one of those names that if this is one of the Dow stocks, probably one of the weaker ones. And the way that you can tell that for sure is the relative strength. So if you are thinking about energy as a potential long idea, I would encourage you to look at the relative strength. This is a sector that has been a consistent underperformer. And until you get an improvement in relative strength, the relative strength line starting to slope higher, putting in some higher lows, I think you have to hold off. I think you have to wait until you get some sign of accumulation. It hasn't happened yet. Our second chart for the 3 and 3 is Japan. So I talked with a lot of the interviewees today about global markets, how you think about US versus non-US. And they all sort of had a similar general theme, which is a chart like Japan. EFA is another one that's close to or breaking to new highs. EWJ is one of the better global ETFs out there. The challenge is, again, the relative strength. So on a relative basis, last couple months overall still positive. So it's well above on a relative basis where it was at the end of July, sort of over the summer. But the last 2 months, the relative strength has been sideways. The US market has rallied just fine. So you're not getting paid a ton to be outside the US just yet. When the EWJ on a relative basis starts to improve, I think you really want to be paying attention to it. And then finally is gold, the GLD. And again, as a diversification opportunity, the GLD and gold can certainly be an interesting opportunity here. I think tactically, though, you have to be looking at this chart. This is a daily chart of the GLD. You can see this pattern of lower highs, a trend line connecting the September and November highs. We have not approached that yet. So to really get interesting, to really show accumulation, the GLD would have to break above the 50-day and also that trend line resistance. We also have found support coming off the 38.2% support level. So we're coming off of Fibonacci support. This is going to go either below support or above resistance. I would be looking for that for a future direction on gold. That is our show for today, folks. I want to thank you so much for joining us on the Final Bar every weekday at 4 p.m. on StockCharts TV. Keep your questions coming. We'll have a mailbag segment in the next couple of days, and we want to answer your questions. The Final Bar at StockCharts.com, or you can get to us on Twitter at Final Bar SCTV. I'm going to be on Bloomberg Television tomorrow after the close. I hope to see you there. And that is Dave Keller saying, have a great night.